Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodge. U.S. job numbers that came out on Friday weren't very pretty, at least from what the traders are saying. 142,000 jobs addition was below expectations of 200,000. Are you putting much weight on this?
Good morning, Julian. Well, no, I believe our economy continues to grow and we are in better growth position than most of the rest of the world. But yes, I do believe we will be more susceptible to what's happening with the economies of our major trading partners and the world geopolitics that's happening, and that changes. The trend right now is somewhat negative. It also adds some economic credibility to our market weakness that has been expanding, and it increases the market's potential for sentiment weakness in reaction to fundamental weakness. So I do believe that overall it does make us more susceptible to a downturn.
Now, the U.S. markets initially came down in Friday's trading, but ended the week up about 1%. Traders are now saying that 2015 may not actually see an interest rate rise. What's your take on this?
The market's perception is that it's much less likely. I agree with that. Maybe in December, more likely next year. Because of that, the bad news from an economic fundamental point of view is good news from a market point of view, at least for the short term. So the market's reaction is more based on the fact, the perception that interest rates will stay low, and that will support market stability and growth. But that's, Julian, that's a short-term reaction. Actually, we'll begin to look to earnings reporting season next week. That will be getting away Tuesday, Wednesday. Analysts are forecasting that profits will trail year-ago results, so the usual comparison game of beating lowered expectations should be even easier than usual. We're also going to be watching for the global growth question, and that will be answered quickly by earnings reports from the big multinationals, which should clarify whether we are not seeing a big slowdown in global growth. There was a big flight to safety this week of capital as the yield of our 10-year U.S. Treasury dipped back below 2%. So that shows that even with Friday's stock market strength, there was a capital-seeking safety for most of the week. This will be watched very closely next week.
Now, talking about safety, Dodge, I just want to touch on the emerging markets a little. They're seeing huge fund outflows. Are you going with the tide of pulling out of EMs, or are you just being a contrarian and making a bet to go in right now?
Julian, it's too soon to be a contrarian. There's been significant weakness, and unfortunately, the reliance of emerging markets on the U.S. dollar is much higher than it should be relative to the percent of economic growth and economic productivity. So because of that, we see more of an opportunity in U.S. stocks at this point relative to emerging markets. The medium-term trend is down, but if we can get above, in other words, we have to see that the emerging markets, or the perception of emerging markets, becomes more positive, and that the market reaction to economic and geopolitical news is more positive. If that happens, we probably would be buying them sooner than we would be buying the rest of the market overall for the longer term. But it's going to have to prove itself, Julian, and it's much too soon to be a contrarian.
And given that the interest rate rise is delayed yet again, are you seeing that the U.S. dollar would actually weaken?
Ultimately, I think it will, but I do believe that the overall strength, it does allow us to look at financials and financial stocks and banks, et cetera, from a short-term perspective. But I do think that ultimately the U.S. dollar is going to remain stronger relative to where it should be in economic terms. And that is a concern that will be a challenge for our markets to overcome, not only internally or domestically, but also relative to other economies.
Now, the financial sector that you talked about is pretty interesting. They should benefit from an interest rate rise, but now that this is being delayed, how do you think you're going to play this sector?
Very carefully, Julian. In fact, most of the major banks are well below. If you take a look at their charts, they're well below longer-term investor cost value. And so we are expecting the major banks, Citicorp, J.P. Morgan Chase, at least over here, to rally. But we would be sellers of J.P. Morgan Chase if it can get up to the 62 or 63 area. But what we're really seeing, and it's kind of interesting, we're seeing much more activity and interest in smaller banks and also in what we call payment processors, and that is very unusual. And these are not institutional clients because their volume is much smaller. But if you take a look, there has been longer-term growth, and smaller banks have been emerging as market leaders over here for months now, thanks in large part to the expectations that higher interest rates will benefit their net interest margins. So they probably will continue to grow, even if there is a delay in the actual beginning of the growth of interest rates. However, they're very thinly traded. And because of that, Julian, they're much less attractive to institutional investors. So it's going to be very hard for institutional investors to climb on board. Also, but one other area that we see with potential lower increasing interest rates, we're beginning to see an interest in REITs, real estate investment trusts, which we haven't seen for quite a while. The names still are fairly low. I mean, we were seeing mid-American apartment communities over here beginning to develop some real potential demand for the longer term. So I suspect that there will be more interest in our REIT sector and that there will be longer-term potential, not just short-term trading opportunities.
Thank you. That was Dorland, Chief Investments Officer at Lander & Fuse Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6, ends 8/25/12.